All right. Hello, everyone. We've got Jack from Wayfair joining us. We're going to be talking about domestic supply chains, the ocean side of things, and where things are headed in terms of consumer demand and uh, retail inventory volumes and what's going on in the ocean market in general. So, Jack, thank you for joining us.
No, thanks for having me, Rachel. Great to see you again.
So we were just talking a little bit about how, there's a lot of talk that ocean volumes are declining a bit. This should theoretically be good for shippers such as Wayfair. Maybe we'll see a little bit more fluidity, a bit more of improved service at the ports. How is that going? Are you really seeing things start to improve and quote get back to normal again?
Yeah, no, I mean, I think that's a $1 million question right now because you are seeing imports decreasing. I think the proof is in the pudding, so to speak. So you are seeing a more fluidity, as you stated, at the ports and terminals. However, the inland transportation segment is still struggling a little bit. The President Biden, the government had stepped in to avoid the rail strike lately over the last week. So you are still seeing some congestion. You're still seeing some labor issues at warehouses and whatnot. So the inland domestic side is still being affected by the the overall lack of fluidity they're seeing. So yeah, you are seeing it along the ports and terminals. However, it's not as prevalent right now on the inland side.
As you mentioned, we did avoid that rail strike thanks to quick work from Congress and Biden and our federal government stepping in at basically the last minute to try to avoid this rail strike. But I imagine it still was pretty disruptive for durable goods importers like Wayfair. I guess how did you guys manage the threat of a rail strike, and did that disrupt any of your planning for this peak season?
Yeah, no, we were very cognitive of the situation. We're staying in close contact with our partner carriers on the ocean and on the dray side, talking to the terminals and the ports, just making sure that we're getting all the information. And just like any large organization, we were digesting it and coming up with plans with our partner carriers. So it didn't cause any disruptions, but we knew that if the strike did occur, that we would have to act fast. A lot of people would look to transload or get those boxes off the coast and over the road get them into the inland market. So it wasn't so much a disruption as we were trying to use the best practices that we were able to develop during COVID and institute it here where we're prepared and that our customers would have, they really wouldn't see any issues on the supply side. So disruptive a little bit, but it just was a little bit more hours that we were putting into work every day.
Yeah, because I think when we talk about rail, we often think, oh, okay, it's chemicals, it's fertilizers, it's agricultural, but I think it's about 30% of rail volume is actually intermodal, so just the day-to-day consumer goods that we all consume.
Exactly. Yeah, I mean, I love intermodal. It's great for the environment. It's a lower cost for what we do. As long as we're planning accordingly, we're working with our suppliers, understanding customer demand. We're able to utilize a less expensive transportation mode, along with the just the benefits of the environment. But yeah, like you said, it's I don't think people understand how many goods are moved on the rails domestically in North America.
So let's zoom in a little bit. You've talked that the fluidity is not quite what it was perhaps pre-COVID on the port side. Can you give it like an example of where we're seeing still some supply chain chaos or disruption or basically issues or entanglements?
Yeah, no, I mean, I think what you're seeing right now, you're seeing a lot of suppliers maybe struggling still with inventory levels that were out of season. So they did try to bring them in early. They couldn't get them over the summer per se, and they had to wait for that inventory cycle to continue. So that's where you're seeing some suppliers where maybe we are able to get the containers out of the terminals. Chassis are more within the network; they're available, so to speak. But once they get to certain suppliers, depending on what they're selling, you're still seeing that box sitting there past 3 days of per diem. You're tying up equipment that people need to create revenue. So that's kind of where we're still seeing some issues. It's hit and miss. Has it gotten better? 100%. We've seen our warehouses be able to do the throughput much better. So, Wayfair's doing better, but you are seeing it in the market pretty prevalently.
So it's a lot of, let's say, containers stuck at rail yards, things just kind of stuck and not quite being able to move through the system normally.
Exactly. Yeah, the rail is probably where we're seeing a lot of the issues, just more inland. So, but yeah, it's getting it out. The day of notification plus one is very difficult, especially when you're tying up equipment. So the costs continue to rise, and people are coming up with solutions. But if you don't have that equipment and the box continues to sit at the terminal, you're just going to accrue costs, and it's going to be difficult to come up with a solution.
Yeah, yeah. I feel like, we hear kind of maybe on CNBC or other big business outlets saying, okay, we see spot rates decline, we see ocean rates decline. Now, maybe we'll see these deflationary pressures, but I feel like one side of things they're not really discussing is, well, a lot of those goods were moved over really high spot during really high periods of elevated spot rates. The other thing is just what you mentioned now with the idea that you might have inventory sitting there in warehouses or in rail yards waiting to get moved, accruing more costs. So this sort of deflationary pressure, at least in my perspective, hasn't quite come down yet.
No, I think that's right. You people just see kind of what's going on in the spot market, and I believe it did drop faster than anyone would have expected. So we're very fortunate that we put in a lot of effort and time with partnerships with the steamship. So we're trying to work through it, understand where the bottom of the market's going to be. We do feel that we may not know where the bottom of the market is until after Chinese New Year. I think also fourth quarter is going to be very interesting for a lot of retailers on what's going on with the consumer demand. So, as you stated, though, a lot of people were moving these goods prior to the spot market dropping so significantly. So people are still a little bit in shock when they are seeing the cost of what the steamship was. I need to merge per diem, kind of when there was no fluidity. You're still feeling the effects on your bottom line as invoices are coming in. So Chinese New Year, I think that's when we really expect us, the market, I should say, not us. We should expect to understand kind of did we hit rock bottom on the ocean rates and kind of what the 2023 year will look like.
So a lot of shippers and carriers are really pointing to Chinese New Year as that the period after Chinese New Year as when we'll know where consumer demand is headed. Why is that such a crucial time period to look at for people in the broader economy who are maybe casually following the freight market?
Yeah, no, I think a lot of people are going to understand their inventory levels. You're going to have the numbers come back from Q4 by then. Some people do have low inventory levels. Are expecting the demand to increase in bringing product from anywhere they're importing from Asia, Malaysia, Vietnam. You're seeing a lot of goods coming from there. So I think Chinese New Year is going to be a good time to reflect on what occurred in Q4, look at your inventory levels, understand where consumer demand is, understand what the Fed's going to do. The interest rates, I think, are playing a big role. And just, I think as a whole, people will feel a lot better on where 2023 is going to end up. So I think it's going to be a little looking in the past, understanding where we are and what we expect for the future.
And can you describe the kind of two there seems to be at least two different sides to this. Some people think that 2023 will be a recessionary time, that consumer demand will fall. Others think that we will see actually demand pick back up again, and retailers who maybe have really high inventory can clear some of that out. Can you describe the two different camps, I guess, in this way of thinking?
Yeah, no, I think it's coming down to what is your product and how did you handle COVID. A lot of people had issues bringing inventory in when COVID initially started. People were starting to pull goods forward to make sure that it was getting in before peak season. So I think the two different camps are. It's coming down to what was your experience with COVID on your supply chain? What did you do to mitigate any issues? And we're able to sell out of the inventory. So I mean, we have been fortunate that we're seeing a lot more fluidity through our warehouses. I think we're going to have a very strong Q4, in my opinion, right now. So overall, I think we're in a camp that we were able to adapt fast. We're able to put in a lot of new initiatives on how to handle the unknown, so to speak, and working, a lot. We didn't really, the magic sauce was just really working with our suppliers and working with our vendors to service our suppliers. So, but, some people obviously don't have those relationships, they didn't really find a lot of value in it. So I think they are struggling. So I think based on how you handled it, how mature your organization is, that's kind of how the cookie is going to crumble on what camp you're going to fall in.
Yeah, that makes sense. And kind of going back to the idea of the summit around the domestic supply chain, when we've talked in the past, you've mentioned how you and Wayfair really focus more on those East Coast ports. I guess how does the shift from West to East Coast ports, as we've seen kind of throughout this year and throughout the past few years, what does that mean for domestic trucking markets?
It's very interesting. A lot of the population concentration is obviously driven by the East Coast. So that's why our fulfillment centers are where they are. So we could target our customer and be able to get the product to them as fast as possible. So I think the the unknown, it seems like every few years there's always a potential strike. A lot of people are not having the tolerance to deal with it every 4 years, so they're trying to diversify their supply chain. So you saw the four corner approach, but I think people are starting to get a little bit fed up with it, and they are diverting some of the volume, maybe predominantly to the East Coast rather than the West Coast, where the less headaches they're experiencing, it's worth maybe a longer transit time, and their supply chain and forecasting is becoming more mature. I also think I believe it's something FreightWaves talks about is just what's going on with the trucking market in California, the EV, the emissions. So it's becoming very difficult to do work sometimes on the West Coast. Now that Southern California and the West Coast is ever going away, the transit time is, very attractive, but it's becoming a little bit more difficult to do business out there. So we're not very surprised by it. But it'll be interesting to see what happens with the legislation and that dynamic, along with just kind of how the unions are going to deal with the suppliers, maybe, or freight forwarders, just not having the tolerance anymore of having to deal with this every few years.
Is there any difference in the inland infrastructure if you import a container, say, to LA versus to Savannah? I'm wondering what does the process look like to get that container out of LA versus out of a port like Savannah, if there is any kind of key difference between those two different ports?
Yeah, I think a lot of it plays into an organization. Do some organizations only use one port of entry, so it may go through all of LA, it may only go through Savannah. Where at Wayfair and Cascade Logistics, we have multiple points of entry. So we have, if something happens on the West Coast, we can still bring it on the East Coast and vice versa. So we never want to limit ourselves to only one port of entry because that's when, in our opinion, obstacles become more of a problem than they need to be. It also, I believe, the if you look at the rail network, it's very concentrated. It's very tightly compact on the East Coast versus the West Coast. They're putting in a lot more. The dollars are being put into the infrastructure to do double stacks and that to make it a lot easier. So I think once the infrastructure is more developed and they could do the double stack trains and then maybe it's more attractive on the East Coast. But that's the biggest difference I see is where are you going? What is your strategy? And do you have a tolerance for risk? If you come into one port, it's probably great. You're putting all your eggs in one basket. You can really leverage your complete inbound volume, but you do open yourself up to some disruptions that could really cause chaos in your supply chain. So, but yeah, the overall very strong rail providers on both sides. I think it's just kind of where are you going in your tolerance for risk.
Yeah, yeah, and it seems like kind of the name of the game going forward is avoiding as much risk as possible because we've seen what happens if you go the opposite way.
Exactly. There's so many options, and in the end, even though we're dealing with the import side, we're always thinking of the customer. The Rachel buying hopefully something from Wayfair this week. We want to make sure the experience is the best one that you could experience. So we start from the beginning. We want to mitigate risk. We want to make sure that we're able to get your goods on time in a in a decent, timely manner.
And what should me buying a new nightstand or just people in general kind of look out for in the next year when it comes to Wayfair, just the larger durable goods market?
We have such a strong presence and we have such a strong relationship with our suppliers. I think hopefully we're not seeing people shy away from us. So, I think we have a good business proposal. Once again, I think it's going to be Chinese New Year. It's going to really dictate if people have high inventories, you're going to have to see a lot more liquidation sales. Just kind of getting the product out so they could bring in more inventory. So, I think it's just being cognitive of what's going on in the economy, what's going on with the rate increase, the Fed rate increases. I think that's going to play a larger role than people think in the supply chain. So overall, we're still very aggressive on our rates for our customers. So no change there.
Okay, Jack, thank you so much for joining us. That's all the time we have for today, but always great to hear from you and hear about what's going on at Wayfair.
Great. Thank you, Rachel.